Well, let's take this conversation now forward with Annalisa, the Vice President of Corporate Finance at Moody's Investor Services. Annalisa, thanks so much for joining us here on ET Now. Good afternoon to you. Nothing can seem to stop the US dollar. This is totally out of an emerging market's hands, like that of India. Look at Australia, for example. The Aussie dollar has hit a 2.5-year low. All emerging market currencies are suffering. Donald Trump on Friday threatening that every Chinese import on every good could be levied a new tariff. There seems to be no end to the trade war and nothing that can seem to stop the US dollar.
That's right. I mean, I think we've seen a lot of volatility in the emerging markets here against the U.S. dollar. I think we've been focusing very significantly on our rated base across India and Indonesia because those, of course, are two of the currencies which have been most volatile over the last couple of weeks, and trying to understand the implications of such volatility for some of these specific industries and sectors that are heavily reliant on either U.S. dollar debt or actually can benefit from the U.S. dollar revenue flow coming from this volatility.
Okay, so can you tell us that what is it that investors seem to like at the moment? Commodities also seem to be losing their sheen, maybe because it's one of the victims of the trade war. So are you seeing a re-rating when it comes to the US dollar? I think that is very much the case. And maybe certain commodities like crude oil.
We've seen a re-rating with respect to the sectors in crude oil and others. I'm not actually understanding your question.
Okay, so, we've already discussed that nothing can seem to stop the US dollar. Are you seeing a case maybe for emerging markets who might be worried to come out with their own individual packages led by the sovereign, led by the central banks? The reason I'm also asking this question is because that's something the United States Treasury Department is not going to take to very kindly.
Yeah, no, I don't think that that's sort of what I've been geared up to discuss today. We were talking more about what some of the credit implications are for some of the Indian corporates that are more exposed to the dollar, given their foreign currency debt component.
Karunya as well joining in the conversation. Let's talk a bit more about the Indian currency. The rupee has massively fallen in the last couple of days. Could you also give us a sense of what is the dollar debt that is likely to mature over the next 12 months? How do you see refinancing risk emerging for the Indian corporates?
Sure. I mean, I think for our Indian corporates, it's very manageable, to say the least. There's only about $2 billion worth of U.S. dollar denominated rated bonds that are maturing over the next 12 months, and those are largely out in 2019. So, of course, we'll be expecting companies, given the recent depreciation of the rupee against the dollar, we are going to be expecting them to be very timely in terms of their refinancing. We obviously are across the emerging market sector seeing a increase and rise in pricing and interest costs. So we'll be looking for companies to balance that as well.
And, let's say that the rupee weakens by another 10% or so, because a lot of bears on the market, bears on the currency are actually looking at 80 against the dollar as the next level to watch out for, which could actually play out in the coming few months. So let's say the rupee weakens by another 10%. What do you think will be the impact on some of the Indian corporates and the key sectors that are operating in the Indian market?
Sure. I mean, it's a good question. I mean, I think we could probably run multiple different scenarios. I think, but the way that we've looked at it and across our rated base is that the majority of the companies really do have some sort of protection in place. It's not going to be absolute. It is not going to mute the entire impact, but it will help limit the adverse impact both on cash flows, be it associated with rising interest costs or, higher capital expenditures. So most of the companies have natural hedges in place. We've got a lot of exporters in the mix, And then we also have a lot of companies that have U.S. dollar cash flows coming in. So I think overall, with a further 10% weakening of the rupee against our rated portfolio, we're seeing very limited adverse ratings action and significant credit implications because the companies do have some buffer. As I said, so I don't think that we're going to be looking at a situation where we have a number of companies that go under significant ratings pressure or significant contraction in cash flows in and of itself because of the depreciation. The most of our companies within the Indian sector, we rate 24 companies across India, both in the high yield and the investment grade portfolio. Currently, the majority of those, all but one, are on a stable or positive outlook. So that gives you a sense of sort of the cushion that these companies can absorb.
Hi, Annalisa. So I want to just talk to you a bit more about those 24 Moody's rated Indian-based corporates across the high yield and investment grade categories. I believe these include IT companies, these include the oil and gas packs. So what's the big message? Whether you're an exporter or an importer, this is not the right time maybe to panic. There's no need to panic?
Well, I think, listen, obviously when we looked at sectors, it's a very difficult question to say what is the impact of the depreciation for a specific sector, because obviously different companies are going to be better positioned to withstand the depreciation than others. Either it's going to be reliant upon their financial health, it's going to be reliant upon the fact what's the size of their cash flows, how levered are they, and then, as we said before, the proportion of U.S. dollar or foreign currency debt versus local currency debt. So I think if you're looking at general themes, IT service companies should generally benefit, right? Because they've got a significant cost base in rupees, but they generate a significant portion of their revenues and cash flows in U.S. dollars, okay? Exporters, the same way. Commodity exporters, very similar. On the other hand, you've got locally focused businesses. You've got the TMT sector, right, that generates a significant portion of their revenues and cash flows from local currency and from local consumers, yet still has exposures to U.S. dollar and foreign currency debt. Under those circumstances, you're going to see debt levels rise, interest costs rise, and the cash flows are in rupee terms. So you're going to have a mismatch. So that's going to be a little bit more difficult for those companies in those sectors to withstand. But that said, it's very, very difficult to just say broad stroke that the depreciating rupee is either positive or negative for one specific sector because the companies within each sector are actually uniquely positioned and or have very different financial strengths and financial profiles.
Okay, we're going to leave it at that. Annalisa, thanks so much for joining us with that and giving us an outlook on this crucial report of Moody's. They have analyzed as many as 24 corporates and the impact of the depreciating rupee on all of these companies, which do include those from IT as well as pharmaceuticals. Let's go.